So what I'd like to do, we're going to try this, just a little mini question time type panel, little panel discussion. We've got our two speakers. We've got Joe Wiggins and we've got Donald. I'm going to ask the panel to introduce themselves, and let's just see if we can get engaged on answering some of these questions. So, Nasir, would you like to introduce yourself?
I'm Nasser Zubari. I work for a company called the Currency Cloud. I'm head of product marketing. I've worked in banking and finance for 16 years now, principally in capital markets, covering all areas: foreign exchange, interest rates, Islamic banking, equities, you name it. I've been involved in some way, shape or form. And I've also worked across technology segments as well as the front office.
I'm Joe Wiggins. I'm a PR consultant. Been doing PR for about 13 years now. I've worked for large banks, Santander, or Abbey as it was still then, Nationwide Building Society, Legal & General. So I've kind of done PR from more the corporate comms side of things. And now I tend to focus my time on startups mainly, where financial services meet technology. So my role really is to manage reputations, increasingly so via social media and digital media as well as traditional media as well.
My name is Ian Dowson. The day job is managing the disposal of subsidiaries of PLCs. These tend to be larger businesses. I go in a couple of years beforehand and I'll manage the whole process through to the part which everybody forgets, which is who's going to get the escrow. Previously I've been involved in retailing, leisure, manufacturing and tech, and I love digital media, as you saw from my presentation.
I'm Donald Chapin, Business Semantics Limited. Our team won the FinTech CDAC weekend at Google Campus at the beginning of April for a proposal for mitigating risk of documentary ambiguity in contracts, particularly financial services, derivatives contracts, and fixed income packages. It's based on a standard called Semantics of Business Vocabulary and Business Rules, whose development I led the team over the last 12 years. And this is one of the applications, one of the key applications that we're working on, the business documenting unambiguously using these techniques, the business language of financial services in the Object Management Group, which is a standards organization.
Just keep that, Donald. Okay, so the first question I've got here for the panel is, what is the panel's view on the smartphone as a payment instrument? So should we start with Nazir, because that's very relevant, and then work our way around?
I work in payments. I think smartphone payments is overly hyped, quite simply. I don't think it's going to take off on a massive scale for at least 5 more years. I think there's been an incredible waste of R&D expense by lots and lots of firms jumping in head first, thinking because somebody else is doing it, I must do it. I don't think they've looked at their game properly before investing. We all need our wallets. People are used to using credit cards. We've had a bit of a precursor with the Barclay card and their contactless payment. That hasn't really ever taken off. And I see it almost a bit of a fad at the moment. Somebody will win through, but I don't think it's going to happen anytime soon.
I've got nothing sensible to say on that.
I take the entirely opposite view, and People's Exhibit A is M-Pesa in Kenya and Tanzania, operated by Vodafone. The computing is done by IBM Global Services. 14.1 million people are registered to that. 2 million transactions a day. I had the honor of speaking to the governor of the Kenyan bank, and he told me that they discovered that the money supply, that the money in Kenya was 20% more than they thought, because M-Pesa brought bartering into the financial system. So my belief is that the bottom third, or the bottom 20% of Europe, is being underserved by smartphone money payment systems. There is a tremendous market there. The problem is vested interest, and the vested interest is in the telephone companies and the existing banking architecture.
I'm outside of it, so I'm going to just. My reaction is that smartphones are taking over the world. It's changing the way we're operating with smartphones and iPads and so on. Everything at one level or another. So I think while it may take a long time for it to percolate through, maybe for the reason that you mentioned, I think that it's going to happen.
Yeah, the question was around smartphones. The M-Pesa is a great system, but that's serving the underbanked. They have little access to financial services, and it's done on old technology. It's not done on smartphones. It's a different driver of that business model. They've leapfrogged traditional banking to something far ahead. I would love that to be the case here, but unfortunately we do have the traditional banking system, which is reliant on credit cards, which is reliant on cash, and we all have access to it. Why do I need a smartphone to do that transaction for me when I have a credit card and a wallet, and I'm always going to have one?
I'd love to offer a third dimension, which is a barter currency. I have a lot of experience in the analysis of the financial system. I started the first local exchange trade system as a green money network in London, and I've always dreamt of money transactions, i.e. of a barter currency via telephones, and I'm waiting for the API to be globalized. I don't know who's going to do it, but if not you, I wonder who.
Well, what I'm saying is, as I said, I don't think it's going to take off for a long time. I mean, there's too much vested interest in letting a barter currency or a virtual currency take off in any major shape or form, and who's going to regulate it?
In terms of barter currencies, I've seen commentary about Facebook, you know, them sort of getting into the sort of banking type arena. Obviously, they've got a pretty phenomenal platform in terms of a user base. Do you see any sort of future in that taking off anytime soon?
Well, virtual currencies I think are very, very interesting. Now, Bitcoin's done a lot. Facebook credits, this is I'm going to just give you my opinion. So everyone's been ranting on Twitter for the past 2 days about the Facebook share price. I don't think people are really looking at Facebook credits. I think that's their future. The fact is, Facebook is an internet within an internet. You look at the younger generations, they're on Facebook all the time. They don't look at anything else on the internet, right? Everyone's putting app stores into Facebook. If I was going to build an e-commerce site now, I'd build it first in Facebook. If I'm going to do retail exchange in Facebook and I have to pay with Facebook credits, that's power, right? So they do have a system because they built their own world, right? So you need their currency.
Hi, thanks. I think it's fascinating that you say it's going to take such a long time, 5 years. That's, as long as it's within my lifetime, that's very quick, especially for something like currency. So I guess my question is to the panel: what thinking outside of my lifespan? What do you think the future of currency is, given that the telcos applied for successfully last year to Oftel for doing financial transactions, and how will that change banking and money and virtualization of money? 20 years ago, it was all currency, hard cash that people were throwing around. Now, at the flick of a switch, you've got £1 billion in your, for a banking system, interbank transactions. So, 20 years from now, what do you think the currency is like?
I think you're going to see a lot of local currencies being developed. In Switzerland, a third of the financial transactions go through a local currency. The Treasury didn't believe it. Gresham College took a Treasury minister to Switzerland to see this. I can't remember its name. Yep. Yeah, but that kind of trend, people want control of the banks. They want control of their money. They don't trust RBS. You innovators are going to do something about it.
This next question is, can London really compete with Silicon Valley? Is the government's tech city really viable? Shall we start with Ian?
Yes. I gave 2 illustrations of hard technology actually being on the Silicon Roundabout. I can go on for a long, long time. There is as much hard research being done in London as there is in the Valley, even more when you combine it with the medical research in London. Where we've been bad is being the commercialization of the research, but the R&D director of UCL, he's got £1 billion worth of research. It's free, as I said before. Contact him, monetize it. I believe it is going to continue and expand.
I think we're clearly way behind in terms of generations of people that have been through buyouts or IPOs, because those are the ones that are willing to take the risks. And when they talk to their neighbors and friends, you get a culture where people are willing to give up the cushy life and the big predictable income now, and are willing to invest for the longer term with risk, but for bigger rewards. So I think that's starting to happen. I'm newly involved in Silicon Roundabout since this weekend, 2 months ago, but have been more and more involved because of it. And so I'm looking at it kind of with fresh eyes, but I'm amazed at how much is actually going on in terms of like Seed Camp and these other startup organizations that are priming the pump.
Yeah, I think we have a really vibrant scene. If you scratch beneath the surface, one of your slides alluded to it, all the different groups, meetup groups, and all the social things that can go on, and I think it's a great community. The thing that worries me is funding. It's much, much more difficult to get funding over here than it is in the States, and I do worry that we may be losing, good people over to the States because of that, and what things might have taken off if we had a bit freer access to capital than perhaps over in Silicon Valley. So I think that's my concern.
I'd like to hear what Andy has to say, actually.
Just wanted to say, isn't perhaps the problem that it's far too easy to get funding in America, and people are funding complete load of codswallop, like Facebook at $100 billion dollars, that's going to end up leaving a lot of people with red faces. I mean, isn't London the one that's got its head screwed on, the Valley the one that's lost its own head?
I was having a conversation actually just last week with two prominent people from the VC industry, Joss White, who runs Notion Capital, and Hussein Kanji, you probably know him, Andy. And the debate was basically, where's a better VC scene? Is it here or on the West Coast? It depends on whose perspective you take. Joss White, as an investor, was saying he thinks London's a better VC scene, principally because he has less competition, and therefore due diligence and valuation of businesses, and when they are good businesses, is much fairer and the returns are greater from an investor's perspective. Hussein, who's also an investor, was saying that, well, the opportunity for those investments is lacking because of the capital, and that good businesses or big businesses end up going out to the West Coast for their Series B and Series C. Now, from a statistical perspective, which I happen to know, the returns in the US relative to the returns in the UK for VC investment are pretty much almost the same now. There was a huge bubble in terms of returns in the last .com, 2000 and 2001. And if you look at any chart on this, it's compressed, and the UK hasn't risen much. It's just that the US returns have declined considerably, and the UK stayed fairly steady. It's interesting. I mean, as an entrepreneur, I spent a year and a half looking for money, and I think the big gap, which is something, say, Jeff Cedars addressed a couple of months ago, I think, as well, is actually that startup funding. VC funding you can get, I think, Series A is relatively straightforward to get in this country. Series B and C, when you're looking for big investment, probably West Coast is easier. If you had the choice, go there. But startup funding is a real difficult thing. And especially in FinTech, financial technology is not cheap. And even though you can show that you can do it cheaper than anyone else, cheaper than a bank that would probably spend 2-3 million on a piece of tech, and you can do it for 300k, not everyone's got 300k in their pocket. They're going to need it from somewhere. And trying to raise that amount of money is pretty damn difficult in this country.
Yeah, I would just like to ask or suggest whether it may be possible to transform the technology strategy board with which I have been struggling with, because they kind of promise but don't deliver. One of the hats I'm wearing is the web editor for the SME Innovation Alliance. All of the members are completely frustrated with the fact that neither funding works nor the protection of IP. One guy burned his patents outside Westminster. So I think because we happen to be in new finance, we need to find a proper middle ground rather than the Codswallop VC scene in Silicon, but a kind of measured European style versus the anything goes in Silicon Valley. And to me, for the FinTech route or area or domain, an alternative, I mean, if you like a people's, a community, crowd-funded version of TSB would be a good possibility. And I would appreciate your comments.
The TSB won't spend any money on finance, full stop. I've argued with them about this, but no, finance is not a real business in their orbit. I think they do good work in digital media. But given the choice, they retreat into their bureaucratic shell every occasion. They become protective and civil servant-like. But it's up to us to change them. Right? Keep at them. Right? Don't despair. Right? It will eventually get through.
If I can just echo some of the stuff that you're saying on the panel, we run an accelerator program. We're in Denmark, and we're just bringing it over here into London. And our experience is a lot of the European accelerators, the big prize at the end of the weekend or the camp is that you get to go to Silicon Valley and pitch your ideas to some of the investors over there. There is a cultural difference between Europe and the way the Americans work with their money. And because the media hype is always, across the Atlantic, all our young entrepreneurs, that's what they tap into. They tap into how do they get to be the next Facebook, the next Mark Zuckerberg, and the kind of funding that you need to do that kind of business. But so therefore they think psychologically about having a prototype they can take in front of angels and investors and get their seed investment. And it doesn't work like that over here, either in London or in other parts of Europe. We just have to learn to play the game as investors, as entrepreneurs, how to excite the investors that we have over here. Not just looking to go across the Atlantic and take easy money, because you know as well as I do, it's once you get the money, that's when the hard work starts anyway.
I mean, what do you mean by playing the game? What's the difference in the game in the UK and Europe compared to the US?
Well, I don't know how long we have. First of all, we are far more risk averse. We treat failure in a very different way in Europe than the Americans treat failure. In America, it's an asset. Over here, it's a liability. That's one. That's reflected in the UK, for example, of how when a company folds, how it's treated by the Inland Revenue and the debts that company has as individuals in the company. Compared to the US, it's totally different. In the US, it's exciting. It's almost like it's not a problem at all. Here, it becomes a barrier. That's one. The way that we deal with not just that kind of failure, but the risk associated with taking a company from an inception idea to having invested 50 million before you can get cash flow positive. We treat that totally differently over here than they do in the US. So there's various ways that it's different. And the thing that we have to do as entrepreneurs in the UK, for instance, is we have to understand how our investors invest and what their criteria is. Do they want? They don't invest in the kind of risk profile they do in the Silicon Valley. They invest in companies which have got a little bit more of a track record, some a value proposition which the customers are paying for, etc., before they say now it's worth investing seed capital in.
But that's exactly the point. I don't consider that seed capital. I see that as almost between seed and Series A.
Okay.
It's a seed issue, right? As I said, FinTech specifically, I'm talking from my own experience. We all saw a slide that Ian put up earlier. It had the lovely faces of Market Invoice on there. I was building a business to compete with them a year and a half ago. Everyone we talked to, including people who use those services, really liked our business model. But in the UK, getting someone to actually fund it, no matter how much you try and minimize the risk, ultimately you need X amount of money to build the technology and provide some of the marketing, look to get regulated, etc. I simply didn't have that money in my pocket. Now, yeah, I can go and scrape it together from a bunch of guys, but to, and get it going. And the biggest lesson I learned from that is, as you say, is to have something working and out there, no matter how crap the tech is, almost, if you've got something you can show them, then they're more likely to invest. So it's not quite seed. Seed is literally, here's a business plan, give me some cash, yeah, here you go. That's very, very difficult in this country. The accelerators help, but then is the scale of money enough? It sort of it focuses everyone, and this is the irony of it all. I know people are risk averse here, but I'm also involved in the E100 club at London Business School, right? It's a huge irony that these guys will throw money at anything to do with e-commerce, retail, right? Because it's cheap to set up. They think there's no risk involved, but there is. The irony is they're probably more risky if you've got a solid business plan in a niche sector such as FinTech. E-commerce is 2 a penny these days, and these guys throw money at 25, 30, 35, 50,000 pounds a pop at e-commerce because they think, oh, this is sexy, this is nice, and their brain goes out the window. I find that ironic and slightly frustrating. FinTech VCs in this country and investors are scared of. That's the opinion I formed over the past 2 years. I really think because they find it slightly scary. Financial services has a bit of a bad reputation generically, and people just don't get it quite often as to what the proposition is. They don't want to touch it. Regulation, blah-de-blah-de-blah.
You've stimulated 2 or 3 things in my mind of my recent experience. I underline first off, my impression is that most of what I've seen is business to customer. At FinTech, I'm not sure we were 100% the only one, but we were one of either the only one or one of maybe 1 or 2 business to business propositions. And so the mentality I found was very much toward business to consumer. But I also found it varies second and third old hat. I couldn't believe the amount of stuff that was being repeated. So that's one thing that I didn't see the consciousness and the eyes for the opportunities in business to business, which is sort of like what you were touching on. Secondly, because your point of having to have things to show people, and being in FinTech where things are more complicated, you need more. Typically, they give you £50,000, 40 to 50,000 euros if you're in the seed situation, and that's really not enough. I've invested way more than that in terms of just what I've put into it so far. And so you're halfway in between this seed situation, which isn't enough to actually get you somewhere where you've got something to show to get to the Series A. And so it's this halfway house. I'm stuck in. I don't quite know which way to go on that right now. So that is, I think that is a challenge for investors to step up to and think about. And because if I was an investor, I would see it as an opportunity to figure out a way to package that and make it into a workable package like people have packaged up the seed approach.
Having lived through the .com boom and bust, I think what you guys are saying for the most part is accurate. I will add one thing, that the US is an IPO country. It's changing recently, as we've seen with Facebook, but that's the thing, is When I was involved in startups, people would call each other, everybody was talking, and yeah, we think big. We think we are going to be the next Facebook, we're going to be the next Microsoft, and it happens because people have also a ton of case stories to pull from, and in talking to a bunch of angel investors here, their concern is there's not enough case studies, to show that there's been 10, 15, 20, 25 amazing UK entrepreneurial stories with amazing exit strategies. And then they're the guys and girls who reinvest in new startups. We're not there yet, right? I think what's going on is very exciting. It reminds me again of back in the Apple days where you had the user groups, the Macintosh user groups, everybody's getting together, we were all building applications. That's super exciting. I remember those days, it was great, right? There's a little bit of that here. It's starting to emerge, it's true. But again, until we get a huge, huge case study to pull from, then it's going to be a little bit of a challenge. And again, on the investor side, I think people are really focused here, even more than Silicon Valley. Everybody's so focused on VCs and PEs. Try to build your own company first, get some cash flow from operations, do your sweat equity, because VC is herd mentality, right? So all they do is once they realize that their buddy's investing, they're going to call their other buddy and say, hey, come on in and join the gang as well, right? So I would focus on alternative investment resources such as crowdfunding. I mean, the fact that you've got something like Kickstarter in the US, this is an amazing opportunity for seed capital. There's a ton of crowdfunding platforms here in the UK. I think there's like 44 of them. You've got equity-based, you've got rewards-based, you have CrowdCube. That's a really good source of funding where you don't have to rely on the VCs. I guarantee you when you have a good model, profitable model, the VCs will come and give you money.
So isn't the problem for FinTech companies going into crowdfunding, if we're saying VCs don't understand it, how do you expect the sort of investors you find on crowdfunding platforms to understand FinTech?
I'm not a crowdfunding expert, and I'm not on the panel, so I think it's probably a question for them. But crowdfunding is also very new, right? One of the big categories is film, video, music, technology, et cetera. I think, look, Second Market is a big FinTech player, right? They are liquid assets. They got started, I think, from an ex-finance guy for Barry to start his company in 2007 when he was trying to offload CDOs. There you just go find strategic angels. There's a ton of them, right? And I think people underestimate that. Strategic angels are fantastic, and they're interested in helping you build your company. Whether that's a viable option for crowdfunding, I don't know yet. I think it's still new, but it could be. It's a technology product at the end of the day, right? Financial services is just the service it's providing. So.
On the angel front, I want to build on what you were saying is absolutely true. I'm with a FinTech startup, and we raised angel funding twice, about 6 months apart from two angels. And we tried the VCs. We looked briefly at the crowdsourcing. But finding somebody who is in the space that you're in, understands your business model, they're the people who see it as less of a risk because they can control some of it. Either they can help you find clients or they can help you with the technology. So the key is trying to find, especially in FinTech, somebody who can see the potential of what you're doing and can maybe reduce some of the risk themselves. Anyway, that's what I found when we were trying to raise money.
Yeah, I just struggle with the idea of taking a FinTech company to the crowdfunding space. I don't know.
I think
and talking about, going back to what you said, I haven't seen an example. So.
I think it's still new, that's why.
And of course, there's another source of funding, not just for fintechs, but a lot of startups. And that is, there are a lot of, and Ian had a slide up with all the support, accelerators and seed camps and so on, and our program, which is, if you just look at our program, for example, it's the equivalent of a £50,000 investment if you look at from the full 3-month cycle. Now, if you were getting those services from people like sort of IP law firms and Citrix for their support infrastructures and Rackspace, etc., and you were paying for those over that 3-month period, you'd be funding approximately that much. So there's ways of funding that you can do, which is not just hard cash either.
I think we have time for one final question to the panel, and the question is, which links into what we've just said. Other than raising finance, what are the main barriers to financial innovation in the UK? Other than raising finance, Ian.
I think it's vested interest and tradition, inertia. When you look at AIM and the amount of money that's raised on AIM, about 85% of it's for oil and gas and mineral mining in Africa. You know, they put billions into it, and that is a highly complex market. You have the research skills to enable you to do that amongst the nomads, and a lot of those resource businesses do generate very good returns. But what's needed are the same research skills for FinTech companies and digital media companies within the AIM nomads. And that, I think, is the broken link in the chain of the second and third element of finance and growth for FinTech companies.
Yeah, vested interest, I think, is. It seems like the banks. Now we're down to 4 or 5. You know, just a handful of banks where competition has practically gone out the window, and the fact that the financial services industry, at least in the public mind, is just disconnected from what's going on in the country. And if they can be that disconnected from the whole country that's bailed them out, how in the world are they going to give anybody any space? I could see them proactively killing off FinTech attempts. And this is on being recorded, but still. Behind the scenes, just protecting interest. But I think that's true in any startup situation, and you just have to fight it through.
I'd probably touch on the element of risk aversion, which I think cropped up earlier, which is generally as a nation quite risk averse. So I think risk aversion on behalf of, you know, potential people that are could be involved in a startup, might not be willing to make the jump in this environment, and also perhaps there's an element in financial services of the customer base being not necessarily wanting to try new things and maybe not getting things off the ground that maybe would have done in a more kind of in an environment where people felt freer with their money, and a little bit more confident. So it's probably risk aversion and confidence, I'd say, are 2 elements.
I'll talk about 2 things. The second one's slightly more anecdotal, but I think we all look at this from our own perspective and particular business segment as to who we're targeting as a customer. I do take the point of vested interest. I fundamentally believe the banks just do not have the agility to compete. They cannot move fast enough in technology, but I also think that varies across the scale of who you're targeting. If you're looking to compete with them, and that's why you've probably not heard of many firms that do this in their in their capital markets area, i.e. competing with them to service other financial institutions, hedge funds, asset managers, or large corporates, I think you've got no hope in hell, because the banks will wipe the floor with you in that area, because that's their bread and butter. That's where they make all their money. SME segment, there are arguments to state that the banks, if I was CEO of a bank or a CEO of a bank and I have $100 to invest across all my business area, I would allocate 0 of that to SME market. It's not in their interest to be in that area anymore. This is why I think the FinTech stuff that's targeting SMEs, again, you can argue chicken and egg. I'm in it because I think that's where there's an opportunity, or I'm in it and therefore I think there is an opportunity, whichever way around. But it's true. I mean, capital charge for lending to SMEs, 40%. Compare that to a derivative transaction in capital markets, off balance sheet, 0%. Lending to a large corporate, 8% capital charge. Resource cost to service SME segment. You look at a corporate commercial banking division of a bank, armies of people. You look at the capital markets division, yeah, a lot of people, but slightly slicker, and they're delivering considerably more revenue. There is CEO of a bank should say, I want to get out of the SME business. That's the first thing. So it's largely dependent on where you go. The other anecdotal thing, which is I think applies to all of technology generally, is if you're a business guy with a great idea, finding a CTO is probably the hardest thing on this bloody planet, right? There's a good technologist. A good technologist is either doing his own startup already, or is too risk averse and he needs to get paid about £100,000. He's already working for somebody. If you tie up a CTO as the first thing you bloody well do, because it is the hardest thing to get hold of. It's the rarest commodity in this in this city.
I was reading something on the OC mailing list today, basically criticising the performance of the SCIS scheme, and I was slagging it off on TechCrunch, where I wrote an article about it before it even launched, and apparently the take-up's been really poor for SCIS. And I've not got the latest figures, so there might be some variance compared to what was written on the OC list, but in general, I think that's pretty indicative of the situation. That what we're seeing here is a fairly gross failure of government meddling. We've seen criticism in the room of the way the TSB is operating. Implicitly we've heard criticism of the way the banking system's been regulated because an oligopoly has been allowed to emerge. And I think just as a kind of counterpoint to the comments that the panel were making about the question that was just raised, is really, to my view, there's a massive failure in supply side. The reason we don't have any CTOs is because we don't train anybody to bloody code. And if the TSB and the Tech City just packed up tomorrow and went home and put that money into giving kids Raspberry Pis and some kind of education in coding, then within a couple of years or so, you'd have people coming out of school and coming out the back end of university actually able to write a bit of code. And what we need at the moment is coders, so you don't have to go to Sri Lanka and Ukraine to get your coding done. You can go to Basingstoke and get someone that can write you a decent bit of LAMP. And that is, in my view, where things are all falling down. It's not a matter of a lack of ingenuity. Capital, yes, we are tight on capital, but just to reflect on the point that you personally were making, I think you're looking at a lagging indicator. I think the performance of London-based investments in this cycle is probably going to outperform those in the Valley because there's too much money chasing too few goods out in the Valley. In London, that's not the case. There is still, cherry picking going on by the VCs. But the more I get involved in the scene, the more I come to the opinion that we have a massive supply side failure of quality people being trained in the skills that are needed to make this sector of the economy work. People have been trained in computers not to, just to play with them, not to actually code for them. It's a tragedy, and Google have rightly picked that up.
Okay, can I just thank the panel? Can we just thank the panel?
Yeah.
The next seminar is on June the 26th, probably here. I haven't actually booked it yet. And other than that, just thanks for coming, and I hope you enjoyed the session.